first of a couple of lectures on the differences and similarities between International Financial Reporting Standards and U.S. GAAP. One of the fundamental differences we've talked about with regard to U.S. GAAP and IFRS is the distinction between principles-based and rules-based standards. U.S. GAAP standards are considered to be far more rules-based than International Financial Reporting Standards. This means that GAAP tends to have very detailed prescriptive rules. It tends to require extensive disclosure. There is a lot of guidance on clarity of how to apply GAAP in an effort to increase comparability. And as we talk through some of the differences and similarities, we'll see that this is more true of some rules than others. So one result of having a rules-based system is that in a lot of situations, what gets emphasized is form over substance, which is not a good thing. We'll be looking at an example of leases shortly to see exactly what I mean there. With regard to IFRS, this is a system of rules that is considered to be more principled based. So remember that IFRS is created to be adaptable to a lot of different financial environments and situations. So by having it be principles based rather than very detailed rules based, this provides for more flexibility, more room for judgment. In the past, IFRS has not required a great deal of disclosure, but as it adapts to become closer to U.S. GAAP, disclosure is becoming increasingly extensive. Comparing principles-based systems to rules-based systems, a principles-based system is more likely to emphasize substance over form. When we say something is principles-based and we say it emphasizes substance over form, instead of having a strict rule that says if X, Y, and Z are true, you're going to treat it this way, that's form over substance. Substance over form looks at the actual substance of the transaction and tries to record it in such a way that reflects that substance instead of just conforming to this set of checklist. The example that we're going to use to talk about principle-based versus rules-based accounting standards has to do with leases. So we know that in recent years, both U.S. GAAP and IFRS have put out new lease accounting standards. The reason why both systems needed a new lease accounting standard is because companies were structuring their leases in such a way that they could keep both the asset and the liability off of the books. So this is what we refer to as off-balance sheet financing. So in the U.S. rule, the rule is capitalize the leased asset and report the long-term lease liability on the balance sheet if one of the following four criteria is met. One of those is bargain purchase option, another is automatic transfer of the asset, and then these two last ones are the ones we want to focus on. The lease term is 75% or more of the economic life of the asset, and the present value of the minimum lease payments is 90% or more of the fair value of the asset. So the new lease accounting standard keeps these same basic criteria, but the big difference between the old lease accounting standard and the new lease accounting standard is that all leases go on the balance sheet, the leased asset and the lease liability. So this 75% and the 90% that are used in those last two criteria are what we call bright line criteria. And this is what allowed for companies to structure the leases in such a way that they did not have to put them on the balance sheet. So for example, you only have to meet one of those criteria to be a capital lease, or what's now known as a finance lease. So you could leave out the bargain purchase option, you could leave out the automatic transfer, you could put the lease term at 74% of the economic life of the asset and make the present value of the minimum lease payments 89% of the fair value of the asset. And even though the substance of the transaction was you're buying the asset, it's your asset, and you have a long-term liability, if you didn't have to check any of those boxes, you could not record it as a long-term lease on your books. All right, so that's what we mean by substance over form. When you go out and you buy a long-term asset and you've got a lease that's substantially all of the asset's economic life, you're buying that asset. The asset needs to go on your books and the liability needs to go on your books. That's what we mean by substance over form. IFRS has and had the same basic criteria for a finance lease, but instead of using those bright line criteria, they said that their criteria were going to be the lease term is for the major part of the economic life of the asset, even if the title is not transferred. And at the inception of the lease, the present value of the minimum lease payments amounts to substantially all of the fair value of the leased asset. So instead of having those bright line criteria, that very specific rule, which could then be avoided in the case of US GAAP, this is more vague. It does require more judgment, but it's ultimately going to emphasize substance over form, where the lease was more likely to get reported as a long-term lease and a long-term asset. So new lease standards were issued in 2016. The rules converged on some accounting treatments, but not all, and it did change it where virtually all leases will be reported on the statement of financial position. So no more off-balance sheet financing via leases. So some of the differences between US GAAP and IFRS have to do with terminology. So the terms reserves and provisions are examples of that. So in general, we don't really use the term reserve or provision at all with US GAAP. So we don't have reserves, but the term allowance may refer to the same idea. And we don't have what IFRS calls provisions. It's actually what we call a loss contingency in US GAAP. So under IFRS, reserves are an element of equity. It can refer to undistributed profits, and in some cases, it is intended to provide protection for creditors. So for example, under French law, a company has to set aside 5% of annual distributable profits in a legal reserve until the reserve equals 10% of capital. So in other words, a company can't take its equity and distribute it all in the form of dividends. There is X amount that they have to leave in the business in order to protect the creditors. So this is also the same in Germany and in Belgium. So in the US, we might have restrictions of retained earnings for specific purposes. The board of directors is who's typically going to restrict retained earnings for one purpose or another, but that's not going to be the same as a reserve. So the term provisions under IFRS are going to be amounts that are accrued with a charge against income. So they can be used to smooth income. In the US, we would refer to this as an earnings management technique known as a cookie jar, but in some situations under IFRS and countries where the local GAAP equals the tax accounting, a provision is a way of managing earnings, smoothing earnings. So the primary way that the term provisions is used under IFRS is that's what they call a contingent liability. All right, so a liability of an uncertain timing or amount is called a contingent liability under US GAAP, meaning that the loss is probable and the amount can be reasonably estimated. Contingent liabilities under IFRS are possible liabilities, or those that cannot be quantified, which means that they're not going to be accrued. Okay, so when we use the term contingent liability under US GAAP, that means we are going to make an accrual for it. The loss is probable, we can reasonably estimate the amount. That is what IFRS would call a provision, and then they would call a contingent liability something that you're not going to accrue because it's either only possible or it can't be quantified. So one of the other ways that the rules on contingent liabilities differ between IFRS and US GAAP is that, in some cases, that reasonable estimate is just going to be a range of activity. And if you have a range of activity and no amount within the range is more probable than any other amount within the range, under US GAAP, we're going to accrue the minimum. Under IFRS, you would accrue the midpoint of the range. So when we talk about, more and less conservative of accounting rules, we can talk about situations where IFRS is more conservative than GAAP, and we can talk about other situations where GAAP is more conservative than IFRS. So in this situation, what's going to be the more conservative rule there? Accruing the minimum or accruing the midpoint? So under IFRS, you would wind up with a larger liability accrual than under US GAAP. So in that situation, IFRS is less conservative than US GAAP. So the term provisions has two different meanings, to sum this back up. A liability of uncertain timing or amount. It's a contingent liability in US GAAP. It's what we call a contingent liability in US GAAP. Examples are going to be things like warranties and ongoing litigation. And provisions in local GAAP are driven by conservatism and tax regulations. Another way that the term provision might be used is that it's an allowance against the value of an asset, such as a valuation account, accumulated depreciation, allowance for doubtful accounts under US GAAP. Under IFRS, they might call it provision for bad debts or provision for depreciation. Under some national GAAP, provisions may include estimates for expenses that are tax deductible in the current period but will not be incurred until later periods. For example, planned repairs or expenses. This doesn't meet the definition of a liability under IFRS or US GAAP. All right, but remember at the same time that countries that have adopted IFRS, in a lot of cases, it's just they're publicly traded companies that are using IFRS, and the rest of the country is using what we would refer to as their national GAAP. Another way in which US GAAP and IFRS differ has to do with measurement principles. So, going back to the idea of conceptual frameworks. So when we think about our conceptual framework, part of what we've studied is measurement principles. And the two basic measurement principles are going to be the historical cost principle and the fair value principle. Under IFRS, they have the same two basic measurement principles, but ultimately there's variations on that theme, okay? Net realizable value, present value, amortized cost, and so on. So when we talk about measurement principles, in terms of GAAP, there tends to be a requirement of what you have to use, where we've talked about before when countries adopt IFRS, in a lot of cases they'll say this is the treatment that is allowed versus required. So the measurement principles one of the ways that IFRS and US GAAP differ is the degree to which variations from cost are allowed or required. All right, so historical cost is the measurement principle with which we should all be most familiar, as it is the traditional practice under US GAAP. The rationale for that is that it is objective and verifiable. Under US GAAP, we're moving more towards fair value measurement to conform with international financial reporting standards, and so US GAAP has fairly detailed rules on fair value. For example, the fair value hierarchy, which specifies level 1, level 2, and level 3 fair value numbers. So historically, a lot of European countries strictly used historical cost. German GAAP is an example of that. If you recall, German GAAP is also a tax-based system. It's very conservative. Tax accounting tended to be the same as local GAAP. There's not a lot of room for judgment. German companies have typically been financed with debt financing through banks, and that's why it tended to be more conservative. So they were inclined to write down things, but not write them up. Fair value measurement is becoming increasingly important because it's considered to be more relevant in a lot of situations. So we've got a trade-off here between objective and verifiable, which has to do with faithful representation, versus what's relevant but might be more subjective. But when you can get a direct quote from an active market, that is just as objective and verifiable as historical cost. So that tends to be the situation in which IFRS and US GAAP are both embracing fair value. So how is fair value going to be measured? In some cases, it might be replacement cost. In some cases, it might be an inflation-adjusted amount. In some cases, you could have a direct quote from an active market, but in other cases, you might be looking at a discounted cash flow analysis. So US GAAP on fair value is based on the fair value hierarchy, levels 1 through 3. I kind of have my shorthand for talking about this. A level 1 fair value number is a direct quote from an active market. So for example, if I wanted to see the price at which Zoom stock is trading today, I could look it up online, New York Stock Exchange, and that would be a direct quote from an active market, and that would be a very objective and verifiable fair value number. Fair value adjustments are required or permitted under US GAAP, with some adjustments going to net income and others going to OCI. All right, so if we're talking about any kind of security that's actively traded, that's going to be adjusted to fair value, and the adjustment is going to go to net income, whereas with some debt securities, an adjustment would be going to OCI. So The fair value hierarchy applies to both financial assets and financial liabilities. For level 2, it's a less active market or a similar but not identical asset or liability. And level 3 is a discounted cash flow analysis. So to do a discounted cash flow analysis, you've got to do a lot of estimates there. You've got to estimate inflows, estimate outflows, estimate the period of time over which you would be receiving these cash flows, and then come up with the appropriate cost of capital. So that one's going to be pretty subjective, and under US GAAP, we might use that for an impairment loss, but we would not likely report an asset at a level 3 fair value number. So essentially what we've got between historical cost and fair value is a trade-off between relevance and faithful representation. So fair value might be more relevant, but it might not be a very good faithful representation. Historical cost is a good faithful representation, but in some situations it just might not be very relevant. So under IFRS and UK GAAP, they use fair value much more readily than US GAAP. One of the big differences, if you were looking at an IFRS balance sheet and a US company balance sheet, is you'd want to look at whether or not the IFRS company had revalued some of their tangible or intangible assets. So IFRS allows for the option of revaluation, which basically means at any given financial statement date, they can choose to adjust things like property, plant, and equipment to fair value. So if we adjust something upwards or downwards, we're going to have an unrealized gain or loss. And those unrealized gains and losses under IFRS go to OCI and are reported as a component of equity known as revaluation surplus. So when we adjust not land, but plant and equipment upward, your depreciation expense is also going to increase. All right, so this is a pretty major difference between US GAAP and IFRS. Most IFRS companies don't do this. As you can imagine, it kind of messes with consistency and comparability. There's a lot of cost involved in revaluing assets. And if you take an unrealized gain and it goes to OCI, your increased depreciation expense is still going to be decreasing your net income. All right, so and another important takeaway there is that if a company, one of the ways that you could tell if it's a company is revaluing assets is that they would have this revaluation surplus as a line item in their equity section on their balance sheet. All right, so no revaluation under US GAAP. So we do use fair value measurements in impairment losses under both IFRS and GAAP. So we know that the basic idea of an impairment loss is that the fair value of the asset has fallen significantly below the cost so that the carrying value of the asset is not recoverable. All right, so under both IFRS, they would recognize impairment losses, but only IFRS allows for recovery of impairment up to the acquisition cost. All right, so we've got an asset, we've taken the value down under an impairment loss. You're basically going to do that the same way under IFRS and US GAAP. But if there's recovery of impairment on the IFRS asset, you can take it back up to its original cost. All right, and under US GAAP, there's no recovery of impairment. Actually, the one situation in which you would wind up recording recovery of impairment under US GAAP is if the asset is held for sale rather than held for use. You reported it at net realizable value, which is fair value less cost to sell. So if your asset is still in use, you would never record recovery of impairment under US GAAP, but if you have it held for sale, then you are allowed to do it in that situation. All right, so inventory cost flow assumptions. This is another biggie. We know that inventory cost flow assumptions, it's an assumption that a company makes about the order in which it is selling the goods. It doesn't have anything to do with the physical flow of the assets. And under US GAAP, we have LIFO, FIFO, and weighted average. So under IFRS, there is no LIFO. So they only allow FIFO and weighted average costing. All right, so one of the things that you might remember about LIFO is that if a company uses LIFO, they are going to report in the notes to their financial statements the LIFO reserve. And so the LIFO reserve is basically the difference between the LIFO valuation and weighted average, or the FIFO valuation and the LIFO valuation. So if you were comparing a U.S. company and an IFRS company, and the U.S. GAAP company used LIFO, you should be able to use that LIFO reserve to convert and have some comparability there. All right, but that is especially in periods where you've had a lot of rising prices. The differences in those inventory cost flow assumptions can make a significant difference. So why do U.S. companies like to use LIFO? Because in periods of rising prices, it's going to result in higher cost of goods sold, lower net income, and lower taxes on the income statement. There's a lot of resistance among U.S. companies to getting rid of LIFO as a result of this. So LIFO at the same time will result in a lower inventory value being reported on the statement of financial position in periods of rising prices. So in terms of required financial statements and disclosures, both U.S. GAAP companies and IFRS companies are going to put out the same basic set of financial statements. We might have some terminology differences here. Under IFRS and in the UK, a lot of times we'll be calling it the balance sheet, the statement of financial position. But if you go through and actually look at IFRS companies, my experience is that I see balance sheet as often as I see statement of financial position. A statement of profit or loss is what our income statement might be called. We know that in addition to an income statement, if a company has other comprehensive income, they are going to need to do either a separate statement or a combined statement of comprehensive income. It's basically going to be the same under IFRS and US GAAP. A statement of changes in equity or a statement of retained earnings is a required financial statement, as is the statement of cash flows for the period. Both require notes, which include a summary of significant policies as well as other explanatory notes. And financial statements are generally going to be presented on a comparative basis. So some of the difference in a statement of financial position or a balance sheet format. Under US GAAP, typically current assets are listed first, and then they're listed in order of liquidity. So if we're talking about a classified balance sheet, we know that we would have, those 4 or 5 basic categories. We would have current assets, we would have long-term investments, we would have PP&E, we would have intangibles, and sometimes you might see an other non-current assets section. But the current assets are going to be listed first and listed in order of liquidity. Then we're going to have current liabilities, non-current liabilities, and the equity section. So in addition to US GAAP, countries that follow US GAAP, Canada, Mexico, and Japan tend to follow that same balance sheet format as well. So some IFRS financial statements follow what's basically the flip of this. Okay, so current assets are last and in reverse order of liquidity. So their balance sheet, classified balance sheet, might start with intangible assets and then go to PP&E, long-term investments, and then current assets last, and list in reverse order of liquidity, which means that on the US GAAP balance sheet, cash is the first asset listed, where under IFRS, cash is the last asset listed. So if you go look at a selection of companies that are using IFRS, you'll really find that this is a mixed bag. So some of them will follow this IFRS format, but some of them will just do the US format. All right, so under the IFRS format, equity is presented before liabilities. So for example, instead of saying current liabilities, non-current liabilities, equity, it's going to go equity, non-current liabilities, current liabilities. So this is the traditional IFRS format, and it's used in local GAAP in a number of other countries. So we talked some about disclosure earlier in the semester, and we talked about the influence of secrecy, the source of financing, on the amount of disclosure that was required under different systems of accounting. So the influence of secrecy, typically low in the US and high in Germanic countries. Sources of financing, bank financing is associated with lower levels of disclosure, where equity financing is associated with higher levels of disclosure. Increasingly in European countries, you're seeing voluntary report disclosure regarding corporate social responsibility.